Welcome to the Titans of Industry show. What a fantastic program today with one of the most knowledgeable fund managers, investors in the field of precious metals. The yearly report his firm publishes called In Gold We Trust is read worldwide, and Ronald is with us again today. How are you doing? How's the $1,500 an ounce world treating you?
It feels pretty well, and actually in euro terms we're very close to new all-time highs. So after some years of suffering, it now really feels good having a look at charts.
You know, before I dive into the questions, I was thinking about this before the interview, and I'm really I don't see the suffering. You know, if we were on a gold standard, imagine we were on gold standard, gold would be $35 an ounce fixed. The fiat monetary system works so good for people to understand that politicians and central bankers are useless, because it went from 35 an ounce to $1,500 an ounce. It actually beat the S&P 500 since 1971. I know we all talk about it beat it since the turn of the century, but man, it beat it in the last 49 years. It's an incredible achievement. And obviously, look, if you bought at 16 to 1900, if you were one of those, unlucky few thousand people that were there for that time, even if you did that and you bought physical, man, you were not wronged. You can go to 73 countries, convert that gold into cash, and buy real estate at all times. So, well, enough about my thoughts. I'm here to get your thoughts, and the audience definitely is here to get your thoughts. Have you had any emails? This is just out of curiosity. Any thank you emails? Any sort of compliments on your report from some big time investors that you want to name drop, and you were like surprised that they even read the report?
Well, actually, and this is the beauty of my job and my profession. We got hundreds of emails from readers, from supporters of the report saying, hey, thank you. You're doing a tremendous job. And every year, the In Gold We Trust that you put out for 13 years now, this is a must read, and it's basically everything you need to know in the gold market. John Hathaway, a good friend of mine, the fund manager at Tocqueville, he said a couple of years ago, actually, the In Gold We Trust report is the most forwarded research piece that he knows in New York. So it seems that the report is not only read in the gold camp, but is also read by institutional players, pension funds, wealth managers, and so on. And this is exactly what we are always talking about. Gold is not a religion. It is a very good inflation hedge. It's a very good equities hedge, and is a very good recession hedge. And I think you should be hedged for those three dangers, for those three risks. And at the moment, it seems that gold is finally really back in a bull market. And we wrote in our last In Gold We Trust report that was coming out end of May, once we're above this 1360 to 1380 major resistance, then there will be huge momentum kicking in, and we are seeing exactly this. Every dip is being bought. Gold is back in a bull market.
And of course, Tocqueville was just acquired by Sprott. Is that correct?
Yeah, absolutely.
So definitely we're seeing some movements also with the institutional money in the gold sector. Funny, I was talking with about 10 major bullion dealers for gold, and they said, look, there's nobody's buying. Like, there's no retail crowd that's buying. It's all the institutions. It's the smart money. It's the people that bought the 2010 and 2011. The retail crowd, they hate gold. They're still burnt from before. So it's very interesting. It's so classic bull market mentality right now, where it's actually like the smart money, and then the retail crowd is waiting for it to hit 1900 for them to say, man, I'm break even. It's now time for me to get in again, instead of dollar cost averaging. But by the way, if you want to get the Incrementum's report, you can go to their website and download it. And I also made it easy. If you go to wealthresearchgroup.com/report, you can just download there, and I would download the extended version. It's a beautiful report. Just it's like a library full of just what's going on with gold and silver right now, and mostly gold, but obviously silver being very similar. A major theme in the report, Ronald, is the lack of trust in institutions. I know you said it's an inflation hedge, it's a recession hedge, etc. For me, it's just a government hedge. Unless I'm missing out on something, politicians are corrupt around the world, and they would always go at the path of least resistance, and they will keep debts at explosive highs and monetize them with these central banks, the sovereign wealth bubble. So to me, it's a government hedge. I want to ask you globally, how much of an issue is lack of trust in government right now?
Well, I think, the leitmotif of this year's report was the erosion of trust. And we're seeing that, we're seeing people are losing confidence, losing trust in the political system, in politicians. We're seeing that long alliances are breaking up. We're seeing that people lose confidence in institutions, in the church, in the military, in the media, of course. And at some point, they will also lose confidence and trust in central banks and probably also in money, in fiat money. So the interesting thing about trust is, and this is why we chose this slightly philosophical topic at the beginning of the report, trust is highly asymmetrical. So it, if I don't know, are you married, Lior?
Happily married.
Happily married, excellent. So you're building up trust through your relationship, and then perhaps, I mean, not you, but somebody else sees his partner having an affair, and all this trust that was built up for years and for decades, within a moment, it's away. And it's the same, we've seen it with Lehman Brothers. Lehman Brothers was around for 157 years. It never had a quarter making a loss, and then within a couple of days, basically, the market lost trust in the balance sheet and the liquidity of Lehman Brothers. So I think it is a crucial topic, and we're quoting, for example, the General Social Service. It actually says only 1 in 5 persons still has confidence in banks, churches, or big business, and only 1 in 10 in government. And we're seeing this, all those right and very left-wing populists winning elections all over the globe. And actually, I think the programs on the very right and very left-wing is to some degree very similar. They're all collectivists. Yeah, they are basically against my thoughts and beliefs that are basically rooted in the Austrian School of Economics, in subjectivism, in basically trust in yourself. So I think that the point of reckoning, the point of loss of trust in central banks is very close, and gold is already discounting this loss of confidence.
What's interesting is the loss of confidence in the institutions is causing trust in new institutions. So in other words, people are always looking for something to trust. I think economically, at least in the U.S., the trust level in Trump that he would do good by the American people economically is rising fast. It's interesting that where I come from originally, I've never voted, but they just broke our prime minister as the longest running prime minister in world history. So it is interesting on that regard. Are we in an everything bubble right now? Because that also implies an everything bust.
Yeah, I mean, it's of course we're seeing today probably 16 trillion US dollar in mostly government debt with negative yields. I tweeted that out today and said you should actually print out that chart with all the government debt having negative yields, because it is history. We're not seeing government bonds and corporate bonds trading at all-time highs. It's the same with equities, although they're at the moment in the process of rolling over. Of course, we're seeing the same with real estate all over the globe, which also seems to be rolling over. The art market and so on. So the biggest anti-bubble probably is in commodities and in gold and in monetary metals, especially silver. So I would assume that if this everything bubble pops, rest assured that central banks will step in and they will have to take even more aggressive measures. It is no coincidence that there's very sophisticated models and studies coming out of the Federal Reserve, for example, making the case for negative rates. It is no coincidence that the ECB already starts talking about more quantitative easing and even lower negative rates. It is no coincidence that MMT is becoming more of a topic on the very right and very left side of the spectrum. So from my point of view, if this everything bubble should turn into an everything bust, central banks will take much more aggressive measures. And I think this time fiscal stimulus will be much more aggressive than in 2008, 2009. And if something like MMT, we always have this alphabet soup and those very sophisticated sounding acronyms like QE or LTRO, and now it's MMT, modern monetary theory. So it seems that everybody thinks that that's the new game in town, but actually MMT is something that the Germans already tried in the Weimar Republic, and that didn't end so well, unfortunately. So it is basically the new darling of the inflationists, and from my point of view, it will have a much more direct effect on inflation. So I think that if this everything bubble turns into a bust, I think central bankers and politicians will make 2008 look like a kindergarten party.
Gold's price is at an all-time high in 73 currencies. That's pretty amazing. Is the dollar next? What do you foresee for the US dollar, and what would be the catalyst for any sort of move higher with gold? I mean, from September 2018 until today, it's up about 25%. If it goes another 25% from here on, it's at an all-time nominal high for the US dollar.
Yeah, well, I think you can read that in the Gold We Trust report. We wrote that actually gold was doing pretty well already in the last couple of years. So it was trading at new all-time highs in Aussie dollar terms, in Canadian dollar terms, and in many other currencies. But everybody just stares at the dollar price of gold. The US dollar was pretty strong the last couple of years because, on a relative basis, central bank policy was much more hawkish than in most other areas. Of course, the Federal Reserve on a relative basis did a very good job, especially compared to the ECB, and they've got some leeway for lowering rates. So of course you can make the case for a strong dollar, but now it seems that the US dollar is in the process of rolling over. Why? Because normally on days when volatility kicks in, when equity markets become nervous, we should see a strength in the US dollar. But on the other hand, in the last couple of, I would say, kind of volatility events, actually the US dollar was weaker. And from my point of view, this is first of all the reason why we're seeing this big de-dollarization environment. But on the other hand, I think the market is pricing in that that the Federal Reserve will have to aggressively lower rates, and therefore the case for the US dollar is getting weaker and weaker. But don't get me wrong, on a long-term basis, the development of all fiat currencies compared to gold is extremely weak, and actually fiat currencies are constantly losing purchasing power measured in gold. There's only one exception, that was the Swiss franc, but the reason is that the Swiss franc has been closely tied to gold until May 2000. So until back then, the Swiss franc was backed with 40% gold reserves, which made it this classical safe haven currency. So in the long run, every fiat currency just depreciates against gold. And it's no matter if it's the euro, the Aussie dollar, the US dollar, and so on. From my point of view, we have moved from a trade war into a currency war. So the last couple of days were extremely interesting when the Chinese devalued the renminbi, and from my point of view, Donald Trump will do whatever it takes to aggressively lower the US dollar. There might be some CCI, countervailing currency intervention, something like that, or even something like another Plaza Accord meeting. So I think a weak US dollar would actually be the best thing for the international economies, for financial markets. It would be a big stimulus. And therefore, I think this might become reality in the next couple of quarters.
Okay, I want to ask you about the correlation, if there is any, between gold prices and the supply-demand output.
From my point of view, I don't think that actually annual supply and demand numbers do have any relevance for the gold price development. There's many people saying peak gold is here, but if you compare the daily trading volume to the yearly production, for example, you can see that actually those changes in yearly production, if it's 1% more or less, that's totally irrelevant, because people fail to understand the stock to flow ratio. So actually we're seeing, and this is the beauty, and this makes gold so special, the supply of gold, which is roughly 190,000 tons, compared to the annual inflation, so the new production, which is 3,200 tons, means that the stock to flow is 60, and the inflation rate for gold is 1.7%. And that makes gold so stable, because if the supply of gold, the production should fall significantly to whatever 2,400 tons, or if it should rise significantly, which is hard to see, especially at current prices, and it would have to happen with huge time lags because of the the whole cycle in the mining industry. But if it would rise significantly to 4,000 tons, it would still mean that your annual inflation rate of gold is fairly small. And this is the big difference compared to fiat money. So 1.7% on average annual inflation in gold, while for fiat money on average it's 8% since the year 1971. So this makes gold so important, and we called the stock to flow ratio, we call it the greatest misunderstanding in the gold sector, because people fail to analyze and to realize that there's such a clear difference between commodities, which can be explained by a very basic consumption model, like crude oil, copper, agricultural commodities, and goods that are bought in order to be held, like gold, diamonds, works of art, or Bitcoin, for example. So while the economic utility of a consumable good is created when it's destroyed or used up like oil, the utility of investment assets like gold is in their possession and in their later resale. So this stock to flow ratio is really important to understand. And this is why we're also explaining it at length in our In Gold We Trust reports.
Ronald, who owns this $15 trillion worth of negative sovereign wealth yielding bonds? I mean, that's 25% of the bonds market. What's going on? Who owns this? Is this smart people that own this?
I wouldn't say that all the people that hold those bonds are dumb. We should not underestimate the regulation that is basically forcing investors to buy safe government debt, and that give gold investors and commodity investors, or also equity investors, a hard time buying those asset classes. So I think financial repression is a very, very large part of this bond bubble. You know, Basel II, Basel III, and so on. Make it just for big institutional investors, make it more appealing to invest in government debt. Of course, at some point, it will basically it will end very badly. We have seen this century bond coming out of my home country, Austria. Century bond, so it's basically 100-year maturity, trading. I think it was at 2.1%, and actually the market went crazy and bought all this government paper. And if I was a politician, I would try to issue as much of those century bonds as possible and roll over short-term debt to long-term debt, and then just wait for inflation. And actually, this is the segue. Inflation is the biggest pain trade, the biggest fear of those investors investing in those 16 trillion of negative yields. Rising inflation is the big pain trade. Nobody believes in rising inflation at the moment. Everybody is scared of deflation, but our incrementum inflation signal already rolled over a couple of weeks ago. On a 3-month basis, the core PCE just rose sharply. And I think the US dollar has been the linchpin of this deflationary mindset. So as soon as the dollar rolls over, I think this will also be a stimulus for the inflation trade, for commodity prices, for emerging markets, and of course also for gold.
So that's very, very interesting. I want to ask you about debt.
Yeah.
Ronald, the Fed chair, Jay Powell, is openly discussing the unsustainability of the national debt. He's making no secret about it. He's just saying, look, we have the reserve currency. The debt situation is so far into the future that it doesn't play into my policy, and that there's nothing to worry about right now. But I just don't understand. It's, to me, it's like saying somebody is obese. He's going to have an issue, but let's not worry about it now. Let's worry about it when he has the heart attack. Why worry about it now? Why change anything now? You see, he's still working. He still has a family life. That's true. He's like 50 kilos overweight, but you know, he's still functioning. So you know, we don't have to do anything for the moment. I just don't get it. That part of the unsustainability of the national debt, I just don't get why it's not a more burning issue for governments. But how does this play into to gold? I know that there's a big correlation between deficits and gold prices. The U.S. Government has to raise a lot of money. I believe the Treasury has to raise about $443 billion in September. And so, you know, tell us a little bit about the correlation and what your analysis is on this, because we're going into a decade where every year it's going to be at least $1 trillion in deficit.
Yeah, I mean, we feature the numbers by the CBO, the Congressional Budget Office, and they said for the next 20 years, actually, the US will have budget deficits above 1 trillion every year, and those assumptions are pretty bullish and to some degree naive, because they think that in the next 20 years there will be no recession. So if a recession happens, of course, those deficits will be significantly bigger. I had a look at the most recent numbers in the US, and it reminded me of this old quote by Ronald Reagan saying, to say Congress is spending like drunken sailors is actually an insult to drunken sailors. So what we're seeing at the moment, it seems that Donald Trump is perhaps the first let's say MMT president, because although we have seen the last couple of years, we have seen basically full employment, we've seen pretty strong growth, at least on the surface, but still deficits are rising, and actually it is mostly coming from government spending. That's actually the big driver at the moment. So government spending jumped 5% annualized, it was led by almost 8% annualized expansion in federal government expenditures. So from my point of view, the fiscal stimulus is already a very powerful force in the US economy. And it seems, from my point of view, that the US economy is in the process of going into recession. The bond market is perfectly signaling that the US economy is weakening for many months now. Today we have seen that the yield curve inversion between the 10 and the 2 years, which is also probably one of the most reliable recession indicators. But it's not only the US, it is a synchronized global slowdown. So the OECD leading indicator has now declined for 17 months in a row. And now is basically at the lowest level in a decade. We're seeing that 11 countries have posted at least one negative quarterly contraction, and 16 central banks are cutting rates already. So it is really a global slowdown that we're seeing. And don't get me wrong, a recession is something normal. And therefore, I think that it is nothing to fear as an investor. You can make great profits as an investor, but Wall Street is not positioned for a recession yet, because we had that in the last gold report. The most famous and probably the smartest economists on the street, out of roughly, I think, 50 economists, nobody, zero, is expecting a recession for the next 3 years. So once there is a shift, when the market realizes, okay, we might already be in a recession, this will make huge changes in portfolio allocations. There will be reshuffling. And I think we're right at the beginning of this process at the moment. So a recession is an extremely positive environment for gold. We're actually analyzing in the gold report how gold performs in 4 different stages of a recession. And the quick answer is gold is a perfect recession hedge.
Ronald, inflation. Everybody knows that is measured differently than before. They exclude the energy prices, the food prices, all that kind of stuff. Led to many conspiracy theories on it, and different economists creating all sorts of variations to the inflation charts. I've been fortunate enough to visit 15 countries in the past 2 years, and about 42 countries since 2008. And except for some pockets that I've seen, it is true that inflation isn't that big of a deal. It's not like it's out of hand in most developed countries. It's certainly not a huge issue in Europe or North America. Look, the Fed thought it would be a huge deal. Gold bugs were shouting through the roof on the QE programs. You produced a chart that was very interesting not in this year's report actually, but in previous ones, where it shows that inflation, it starts on a like literally on a dime. It's
Yeah.
2 year one, it's 2% 1 year, 14% the next, etc. The Fed, Yellen, and now Jay Powell, they say, look, we do not fully understand the phenomenon of inflation. We don't really understand how it works. We thought it would work. We thought we would get inflation with this. Then we thought we would get it with this. Then we thought we would get it. They just can't really understand it. And I want to ask you um, what prompts inflation, in your opinion. What will prompt inflation when we see it? And
Mhm.
do you think we're going from like what we are now, like 1.8 or 1.9 on the official? Do you think we'll see like a spike where it goes to like 3.5 or 4%, like in no time? Because for the dollar to go down 4 or 5% officially every year, that's huge.
Of course, of course. Let me be a bit provocative. I would say we are already in stagflation because we're seeing, growth numbers and also the GDP calculation. If you dig a bit deeper, it is quite, let's say, interesting how GDP is calculated. And then on the other hand, of course, how the CPI or PCE inflation indicators are calculated. I think that doesn't have anything to do with the actual costs of life. So it might be, I'm not sure if it's the levels that Shadow Stats, for example, suggests, like 7 or 8%, but it is definitely higher than officially put out. So we might already be in a stagflationary environment, but nobody is really realizing it, or nobody is talking about that. I think the interesting fact is that we tend to forget what inflation really is. And this is the beauty of the Austrian School of Economics. So basically says inflation, in Latin, inflare, means an increase of the money supply. So first of all, there's monetary inflation. We have seen that, check. Next stage is asset price inflation. We are in this everything bubble, check. And the third stage is consumer price inflation. And this is exactly what politicians and central bankers desperately want to achieve. A friend of mine made this great comparison that he said it is a bit like drinking tequila shots. I haven't done it. I think the last time when I was in college, that's already a while ago. But, at the beginning you feel good and you completely underestimate the time lag until it really kicks in, and then you just wasted and falling asleep on the floor, whatever. So it seems that it is pretty similar with the inflation genie. Once it is out of the bottle, it can go pretty quickly. Now we probably have to see higher energy prices. We have to see a much weaker US dollar to achieve some inflation. And actually, I think this might be a big topic for the next couple of years. And we quoted that in the last In Gold We Trust report. Actually, Bloomberg Business Week had this famous cover in spring saying that inflation is dead. They also talked about the death of equities right at the end of the bear market. So from my point of view, saying that inflation will be rising going forward is a very contrarian topic. It is something that nobody believed. And it's also, I think, that gold discounts inflation very well. And we crunched the numbers and came to the conclusion that actually the gold-silver ratio is a very good inflation indicator. And we just saw that the gold-silver ratio was rolling over. So silver is now outperforming gold again. And therefore, I think that higher inflation might be on the horizon.
Okay, Ronald, again, if people want to download the report, they can go to Incrementum, and you can even look at the description for this interview below and click the link there. Or we made it easy. You can go to wealthresearchgroup.com/report and download the extended version and the short version there. What sort of client investors do you take on at your fund, Ronald?
Well, we're actually at Incrementum. We are doing three different things. First of all, we're doing research. So once a year, the In Gold We Trust report, but we also have the chart books. And then we have on a quarterly basis our sister report, which is the crypto research report, discussing cryptocurrencies, crypto assets, how investors can allocate capital in this new asset class. Then the second part of our business is the wealth management for high net worth individuals, mostly I would say from German speaking countries. It is no coincidence that our business is located in Liechtenstein, in the center of Europe, one of very, very few countries on earth without any government debt. The Liechtenstein family knows the Austrian School of Economics very, very well. So I think it's probably one of the very best jurisdictions all over the world. And then the third part of our business is fund management. We are managing investment funds that mostly invest in precious metals, in commodities, and inflation-sensitive assets. All of our information is on our webpage, incrementum.li. You can download our In Gold We Trust report totally for free. There's a long version, 330 pages, but there's also a compact version which is still 100 pages. And the webpage is ingoldwetrust.li, available in German, in English, and now also in a Chinese edition. So we translated it to Mandarin.
That's perfect. Ronald, again, it was a pleasure speaking with you. We'll definitely circle back as we do every year. And I wish you a lot of luck with everything you're doing.
Thank you very much. Same to you. Thanks for having me. Always a great pleasure being on the show. Thank you, Lior.